The Federal Reserve Bank just finished up their most recent meeting on May 1st, where they said two things. Number one, that inflation is not going away as fast as they would have hoped. And number two, interest rates are not going to be cut as fast as a lot of people would have liked. Now, this might not seem like a big surprise, especially if you've been reading market briefs, but a lot of people have a short-term memory. If you remember back earlier in 2024, the Federal Reserve Bank said that they would be cutting interest rates by their May 1st meeting, which didn't happen. Now everybody's saying that rate cuts might be coming later in 2024, but you're also starting to hear these voices whisper that maybe we're going to see another potential interest rate hike in the future. Let me actually just read you what Larry Summers, the former United States Treasury Secretary, said when it comes to interest rates and inflation. You have to take seriously the possibility that the next interest rate move will be upwards rather than downwards. So what I want to do in this video is go over four things. Number one is I want to go over what data the Federal Reserve Bank looked at to decide not to cut interest rates. What data is the Federal Reserve Bank looking at today, and what did they say about that? Number two is I want to talk about the different options that the Federal Reserve Bank has here during this time where we're seeing a slowing economy and high inflation and still high interest rates. Number three is I want to talk about how this is going to affect real estate and the housing market. And then number four is I want to talk about how these decisions by the Federal Reserve Bank is going to affect businesses and, of course, the stock market for all of you investors out there. So let me start by talking about number one. What data is the Federal Reserve Bank looking at? But before we jump into that, I want to take a quick second to talk about our sponsor, Facet, who's working to help you manage your money better. Investing your money is difficult, especially in this volatile economy with high interest rates and a slowing economy, which is why many Americans turn to financial advisors, which is good. But the downfall is many Americans don't realize how much money they're paying in fees to their financial advisor. For example, did you know that a small 1% fee that you're paying to your financial advisor could end up costing you hundreds of thousands of dollars over the course of your investing career? Well, yes, that's what happens because it's not a 1% fee that you pay one time today. It's a 1% fee that you pay on every dollar that you invest for every year that's invested. And you're also paying that 1% fee on every dollar of profit that you make as well. And so your 1% fee is compounding while your money is trying to compound. But with Facet, you can work with a team of certified financial planners, CFP professionals who do not charge you a percentage of your assets. Instead, they charge you a affordable, flat membership fee. That means you can work with licensed financial advisors without paying a commission to your advisor. You don't have to pay a percentage of the amount of money that you invest, and there's no minimums to how many assets you need, how much money you need to invest to get started with Facet. And the nice thing is that Facet can help you with pretty much every aspect of your financial planning. They can help you with career benefits, they can help you with investing, they can help you with retirement planning, and more, all included in your membership fee. And the best part of all is that because you are watching this video, Facet will be waiving your $250 new member enrollment fee. All you have to do is use my link down in the description below. So if you want to learn more and see how you can get started, I got the link for you down in the description. Minority Mindset is a paid partner with Facet, but if you want to learn more and see how you can get started, I got the link to how you can do that down in the description below. The Federal Reserve Bank follows what's called a dual mandate. That means they look at two different pieces of data when they make the decisions on what to do with interest rates. They take a look at what's going on with unemployment, and then they take a look at what's going on with inflation. They balance these two things, and then they make a decision if they want to raise interest rates, keep interest rates where they are, or if they want to cut interest rates. So you can look at the Federal Reserve Bank kind of like the thermostat checker in our economy. If our economy is getting too hot, it's getting too overheated, people are spending too much money, inflation is getting out of control, they'll try to cool down the economy by raising interest rates, by making things a little bit more expensive, especially if you're operating with debt. Versus if they're worried about the economy cooling down too much, the economy is slowing down, people are not spending money, they might try to heat up the economy by cutting interest rates to stimulate the economy, to help spur growth, and to help people go out and spend money. That way it can help boost the economy. What we've been seeing on the unemployment side of data is that unemployment today in the United States, according to the reported data, is still near our record lows. So when the Federal Reserve Bank looks at this super low unemployment data, at sub 4% unemployment, they say, well, unemployment is not an issue, so we're not going to change interest rates based off of unemployment because unemployment is still very low. This gives us fuel as the Federal Reserve Bank to potentially raise interest rates or keep interest rates higher because this is not an issue yet. So now we can look at the inflation data as the Federal Reserve Bank. Between January and today, the data has told us that inflation has been moving higher month over month, not lower. Now, inflation is a little bit tricky because there are a lot of ways to measure inflation, because the inflation that I face might not be the inflation that you face. Like if you were thinking about going out and buying a home today, that inflation that you face might be higher than somebody who's just going out and buying eggs in the grocery store. So the inflation that everybody feels is slightly different, which is why the Federal Reserve Bank even has their own ways to measure inflation. So there's a lot of different ways to measure inflation. And the first number that many people look at is called CPI, the Consumer Price Index. This is also known as the headline inflation number, but the Federal Reserve Bank doesn't like to look at that. Instead, they like to look at what's called core inflation, which means they take a look at this headline inflation number, they take out what they call the volatile numbers, which include energy and food, and this gives you now the core inflation number that the Federal Reserve Bank looks at. Well, starting with the headline inflation, we've seen that in 2024, this headline inflation number has been rising, not falling. But then we have to take a look at core inflation, which is what the Federal Reserve Bank prefers to look at. And just like with headline inflation, core inflation has also been on the rise in 2024. Now, the reason you want to pay attention to this data yourself and not just rely on the Federal Reserve Bank is because, for one, people's incomes have not been rising fast enough to keep up with this inflation in 2024. This is from CNBC. Personal spending rose 0.8% on the month, more than the personal income increase of 0.5%. And the second reason you want to pay attention to this is because, well, people also have less ability to save money when inflation is higher than people's incomes. The personal savings rate fell to 3.2%, down 0.4 percentage points from February and down 2 full percentage points from just 1 year ago. So as the Federal Reserve Bank takes a look at this unemployment number, which is still extremely low, and then they look at these inflation numbers, which are coming in hotter than expected, they have to make a decision, which brings us to part 2 of this video, which is, what are the Federal Reserve Bank's options? When it comes to interest rates, the Federal Reserve Bank has 4 options. And I know the Federal Reserve Bank can also make adjustments with quantitative easing and quantitative tightening, but I'm not talking about that in this video because I want to focus on interest rates. But the Federal Reserve Bank has 4 options when it comes to interest rates. They can keep interest rates where they are, they can raise interest rates, they can cut interest rates, or they can change their goal. Now, what the Federal Reserve Bank has elected to do is keep interest rates. And what a lot of people have been alluding to is that the Federal Reserve Bank will cut interest rates in the near future, but we don't know when. But now you're also starting to hear some little voices, not loud, but little voices talking about how the Federal Reserve Bank might need to raise interest rates in order to tame inflation. Now, of course, all of these things have consequences. I'm going to talk about this one as well. But all of these choices have consequences in our economy, with inflation, and with your wallet, which is why you want to pay attention to this. Because the interest rates, even if you don't have any debt, that are in our economy have an impact in our economy, because they can impact things like housing prices. They can impact things like the interest rate you get on your savings account. They can impact things that are happening in the stock market. And so you want to understand what's happening, because at the end of the day, higher interest rates cool down economies. And the reason why is because when you raise interest rates, you make it more expensive for people to borrow money. Now, we live in an economy that runs on spending. You've probably heard me say this a million times now, but if we run on spending, that means that the more ability somebody has to spend, the more our economy can grow. But we don't live in a cash-based society. We live in a credit-based society. And no, I'm not saying this is a good thing. I'm just telling you how it works, which means that if I make $50,000 a year, I don't have the ability to just spend $50,000 a year. I have the ability to spend $70,000 a year or $100,000 a year because, well, I have the income, my 50 grand that I earn, but I also have debt that I can qualify for. I have credit that I can qualify for. This can be in the forms of credit card debt. This can be in the form of personal loans. This can be in the form of any other sort of line of credit. So now, if I have $100,000 worth of spending, that means I can go out and spend even more money, which can boost the economy today. But if interest rates go up, that means I'm going to be less likely to spend. And why? Because people like to buy things when they're cheap. When Macy's has a Black Friday sale, that's when you see the long lines, because people want to buy things when they're cheap. And when debt is cheap, people go out and spend more money. When debt is more expensive, people have less ability to spend money. So with higher interest rates, people buy less homes, they buy less cars, and they spend less money. Now, the interest rates that we have today are high based off of the last 20 years standards, because over the last couple of decades, we haven't really seen interest rates a lot higher than where we are now. But if we take a look at interest rates over the last 4 or 5 decades, now what you'll see is that the 5 and some % interest rates that the Federal Reserve Bank has set today, not your mortgage rate, the interest rate set by the Federal Reserve Bank, that's relatively low compared to the interest rates that we saw in the early 1980s, which was a couple times what we had today. Because in the early 1980s, if you wanted to go out and buy a home, you weren't going to get a 7% mortgage, you were getting a 15 or an 18% mortgage. So interest rates relative to those historical standards are still low, but when you compare it to what we had in 2021, yes, interest rates are a lot higher today. But this is where we don't know how our economy is going to really respond to these higher interest rates because, well, we've been kind of accustomed to these lower interest rates. Ever since the 2000 dot-com bubble bursting, we've seen relatively low interest rates in our economy. And now what we're starting to see happen is, well, we might be having these higher interest rates for longer than expected, which means businesses might have to get accustomed to these higher interest rates. Real estate investors and developers might have to get more accustomed to these higher interest rates. Consumers might have to get more accustomed to these higher interest rates, which means people might have to cut back on spending, which has an impact on the economy. Now, of course, the Federal Reserve Bank also has one more option, which is they could potentially change their goal. Because right now, the Federal Reserve Bank has an inflation target of 2%. And what they keep saying is that they want to keep their monetary stance restrictive until we hit the 2% inflation target. And what that means is they want to make sure to keep interest rates high until we can get down to this 2% inflation number. Now, what you have to think about is why 2%? There's really no good answer to why 2%. I mean, why not 1%? In fact, why not 0%? Why do we need inflation in the first place? Because inflation hurts consumption. Inflation hurts our ability to go out and shop. It hurts our ability to spend, and inflation disproportionately benefits some people. It disproportionately benefits the asset owners. So inflation is good for some people, but it hurts the general public. So why do we have to have inflation in the first place? And I have to imagine if we start to see more pain in the economy, if the higher interest rates start to cause higher unemployment, it starts to cause even slower economic growth, well, then the Federal Reserve Bank might say, you know what, instead of this 2% inflation number, maybe 3% inflation is okay. Maybe 3.5% inflation is okay, because there's no real reason for the Federal Reserve Bank to arbitrarily choose 2%. Why not 3? Why not 3.5? And this is where you have to imagine that if there is more pain in the economy, the Federal Reserve Bank could say, well, if we really want to bring inflation down, it's going to cause more pain in the economy. So we're going to be a little bit more lax on inflation right now until we can get the economy moving again, which is where you want to understand what the Federal Reserve Bank's options are, which brings us to number 3. Now, if you are interested in the real estate market, then you got to check out the video I published yesterday, which goes over how these higher interest rates are affecting the commercial real estate market. Because what we're seeing happen today is we have about a $1.5 trillion wall of commercial real estate debt that's about to start readjusting. And I did a whole deep dive on this yesterday, so I'm not going to go deeper into that today. But what you have to understand when it comes to real estate is that real estate is one of the most sensitive areas when it comes to interest rates, because as soon as interest rates go up, buying a home immediately becomes more expensive. Not because you need more dollars, but because the cost to borrow those dollars immediately go up. Now, we've been still seeing a very strong housing market today, but naturally, because of the higher interest rates, a lot of people are finding it less affordable to go out and buy a home. But this is where you kind of, again, have this double-edged sword problem, because if you were to cut interest rates, you would make that monthly mortgage payment to borrow that $400,000 less today. And people would assume that, okay, that $500,000 home today would be more affordable if mortgage rates were a whole lot less. But there's a flip side to that argument as well, because if interest rates were to go down, what do you think is going to happen to that $500,000 home? Well, there probably would be a lot more offers of people wanting to buy that $500,000 home. And if you have 20 people now fighting to bid to buy that $500,000 home, it might not sell for $500,000. It might be selling for $530,000, or $550,000, or $570,000, depending on where it is. And so now all of a sudden, when you cut interest rates, you could make that inflation problem worse, especially in the housing market. This is where housing is very sensitive when it comes to interest rates, because interest rates directly impact the demand side of the housing market, because most people are buying a home or they're buying real estate with debt. Not everybody, but most people are. And this is where, if most people are making this huge purchase with debt, the cost of debt is going to impact the affordability of this purchase. And this is where solving this affordability in the housing market problem isn't as simple as just cutting interest rates, because cutting interest rates could make housing even more unaffordable. It can make the prices even more under reach, because now the prices to buy these homes go up during a time where inventory is still relatively limited. And this now brings us to number 4, which is the impact on businesses and the stock market. See, just like with the commercial real estate market, we have a $1 trillion wave of corporate debt that is about to readjust in the coming years. Now, the reason why is because just like commercial real estate, you don't get 30-year fixed rate loans when you go out and borrow money for your business. You're getting 3-year loans, 5-year loans, maybe 7-year loans. And a lot of corporations took out debt in 2020 and 2021, which means a lot of corporations are going to start to see this debt readjust in 2024, 2025, and 2026. Now, if a corporation is making more money, no big deal, because now you have the money to pay off these higher expenses. But if a corporation is not making enough money to cover their expenses and the higher debt costs, then this corporation is going to have to make readjustments. Maybe they're going to have to lay off some of their staff. Maybe they're going to have to shut down some divisions to save some more money. Or maybe they're going to have to do some corporate restructuring in order to pay down this debt, which could potentially include a bankruptcy. And this is where you have to understand the correlation between interest rates and the stock market and businesses in general, because higher interest rates impact businesses because they make doing business generally more expensive. And it likewise impacts asset values, including stock prices. Now, generally, I'm not talking about right now, generally, higher interest rates are downward pressure on the stock market. But over the last few years, we've seen the stock market rise despite the higher interest rates. And this has a lot of people confused. Maybe the higher interest rates are making the stock market go up. Maybe the higher interest rates are actually benefiting the stock market. But you have to remember that there was a lot of money that was printed in 2020 and 2021. And it's going to take time for all the money to be fully absorbed into the economy. But the higher interest rates naturally have downward pressure on the stock market, but the stock market is a reflection of people's opinions about the economy. And you have to remember that today, our economy is still doing very good. I mean, yeah, people are spending money like crazy, but the part that a lot of people don't realize is many times people are spending money through the helps of credit card and through the help of digging into the 401ks and through the help of alternative sources of funding, because more and more people don't have the ability to continue funding their lifestyle just through their incomes. But as long as people are spending, that's good for businesses, which reflects well in the stock market. But if people start to run out of the ability to spend, if people run out of the ability to continue growing their businesses, that's when you start to see more pain in the stock market. Now, am I saying that you need to now be worried about the stock market? No, but I want you to understand how interest rates play an impact on asset prices, because this can also create opportunities for you. This doesn't mean you shouldn't be investing. This means you have to be prepared for opportunities that might come your way, because we know that markets go up and down. We know that our economy goes up and down. And most people assume that the market is going to go in whatever direction that you're in right now. That when the markets are growing, you're always going to be in a growing market. When markets are down, that you're always going to be in a crash market. But that's not the way that it works. And the financially educated and the financially savvy and the people that build the most wealth are the people that can separate their emotions from reality. And they're the ones that understand that I want to be prepared for financial opportunity, but also I want to make sure I have my money in the market, because like Warren Buffett says, time in the market beats time-ing the market. But this requires you to have the financial education and to be financially prepared to be able to capitalize on whatever opportunities might come your way. I can't afford to pay you this 20 times multiple, this $2 million price, because, well, I'm just not going to make any money. I'm going to have to lose money to purchase this property. And instead of paying you $2 million, I will be willing to pay you $1.4 million. And this is where many sellers are saying, or were saying, no, I don't want to sell my $2 million property for $1.4 million.